Hello everyone, I'm Sahil and welcome back to the channel. In this episode of Company Analysis, we are looking at AEM Holding Private Limited. But before we start, I would just like to say that this particular episode is more suited for my Singaporean viewers. Just because if you're outside of Singapore, I don't think you would have access to Singapore Exchange, SGX, where AEM is currently traded. However, if you are already here, then just stick to the video because there will be some information that might be good for you as well. This episode, as usual, I'm dividing it into 5 segments. Firstly, we'll be looking at the company overview. Then we'll look at the competitors, then the financials of the company, moving on to the investment thesis that I have, and lastly, the valuation. Let's get it rolling. Starting with the company overview, AEM basically provides semiconductor and electronic testing solutions to manufacturers. Their customers range from the industries like semiconductor, microelectromechanical systems, MEMS for short, fiber optical cabling, and memory devices. They have their manufacturing plants in Southeast Asia, China, Europe, and US, and have engineering support present in some other countries around the globe. Even though AEM is a small company itself, but they have not only grown through organic innovation, but they have also focused on acquisitions. Since 2017, they have acquired over 7 companies, and this is to bring together the core technology that they require to fulfill their system-level intelligent testing vision. Further exploring their businesses, they have divided it into 4 different segments. The first one is the Equipment System Solution, ESS for short. Second one is the System Level Test and Inspection, SLT for short. Third one is the microelectromechanical system, MEMS for short, and the last one is the test and measurement solutions, TMS. AEM considers itself a leader in the equipment system solutions. In this segment, they provide customized solutions for mass volume manufacturing and new technology development labs. They integrate precise high-speed motion, innovative mechanical design, and amongst other things over here to serve customers in the industries like semiconductor, solar cell, and storage media manufacturing. This business segment also represents their core business since it brings in 96.6% of their revenue, and is also the only business segment that is profitable right now. In the last year 2020, it saw a growth of 62.8% year over year, which is phenomenal. And we will try to understand that more in the financials later on. The second segment involves equipment that tests high density chips at the system level in real end user environment, which involves thermal performance. This represents 1.5% of their revenue in 2020 and saw a growth of 59.2% year over year. The third business segment of MEMS engages in delivering electromechanical systems and special wafer probing needs from R&D phase to high volume production. It represented 1.13% of their revenue in 2020 and actually saw a decrease last year of 20.3%, which the company blamed on COVID disruptions. The last segment of TMS provides cable testing solutions to the automotive and fiber optic industry. So in the automotive industry, right, cars nowadays, everything is electronic, from turning on your aircon to nowadays autonomous driving, which operates on critical systems in the car like sensors and all those things, which require cables to carry the data and feed it to the central computer. It is very critical nowadays because any fault could cause an accident and is a fatal accident per se. So it is very critical to test the systems on a regular basis, not just after manufacturing, but throughout the lifetime of the vehicle. And so it is becoming more and more important to have test equipment that can do it efficiently, and that is where AEM steps in. So it is a autonomous driving play as well, even though short, not just in the chip manufacturing side but also in the cabling side. And then comes the fiber optic industry, which is focused on the 5G, where you need fiber optics, a networking cable throughout a building, or 5G is infrastructure heavy, right? So wherever the infrastructure is, you need the cables to be tested on a regular basis again to find any fault. So that is where this segment comes in as well. So this is future looking, so it doesn't represent a big number right now. It is only 0.7% of the total revenue that AEM generates, and it saw a mere 37.9% growth. AEM also segments its revenue in terms of revenue generated from the sales of tools and machine, which is quite obvious. The second one is consumable and services, which is a recurring revenue once you have sold the machines. And third new one that they have added recently in the first quarter preliminary report of Q1 2021 earnings, which is contract manufacturing. So I'm not really sure where it came from. I believe it's one of the new acquisitions that they have. But then again, they didn't really specify it because it's just a preliminary report that is out right now and not the final one. So I believe they will post it out there. But I think it's really impressive to see consumables, because once you have sold the machines, you still have more revenue coming in through that. And at the same time, semiconductor industry itself, right, has a very fast turnover. So on average, after 5 years, the equipment gets outdated. So you need the companies need to invest again, and it's good for AEM, but that also means that they have to invest a lot into R&D to keep up to the competitors. Talking about competitors, AEM has 4 competitors. First one is Teradyne, which is US based. Second one is Advantest, which is Japan based. Third one is Kohu, which is again US based, and the fourth one is Chroma, which is based in Taiwan. The only way I can compare the competitors with AEM is through numbers, their business figures. I have no knowledge about the equipment itself that they sell and the competitive advantage on that level. I can't really compare it. It can be only done by someone who's in the industry. So we do what we have, right? And if there's someone watching who has a better understanding, please leave it down in the comments again. Teradyne is the biggest amongst the 5 companies represented over here, AEM being the smallest in the block, both in terms of market cap and revenue. The big companies like Teradyne and Advantest definitely has advantage that they are already well established and have working relations with all the big customers out there. This gives them, they understand the needs of the customers very well, and also they are able to push in their new products to these customers. They have the contacts to do so. Whereas for us, if you see a smaller company growing, that means they have something really good to offer. Okay, one thing to understand about B2B businesses, especially engineering businesses, that reliability is a big thing for them. They are not just gonna trust a small company just because their product is slightly cheaper or slightly better. They are focused heavily on servicing of the product. So I was working for ST Engineering, right? And I was tasked to acquire certain products, and they were very specific that they need they need products. They are willing to pay for products slightly higher if the service is available locally. Like, they don't want to buy something from Germany, and if it gets spoiled or it needs servicing, they have to plug the thing out and send it, ship it to Germany and get it back, which is very time consuming. So that's why you see AEM also establishing itself all over the world and opening offices so they can provide localized services where their customers are. It is a good thing that we can see AEM growing, which means they're doing something right. Also, if you look at the other comparable numbers, right, AEM seems to be quite a bargain. Like, if you take the price to free cash flow ratio, this one, obviously the lower it is, the cheaper the stock. So AEM is trading at 14.4x, whereas the next closest competitor is trading at 42.4, which is Chroma, and it is a huge difference. So and the next one, the PE ratio, AEM again is the lowest at 13.2, which is again lower the best. So the next closest competitor is at 19.8. In terms of ROE, AEM is generating the best ROE. So then again, it is great, but maybe that's because it's growing at the moment. However, the next 12-month PEG ratio is not the best for AEM, and that is quite understandable. I will explain why that's the case, because this represents that the 1 year expectations of revenue growth for AEM is not that great, and I will explain later why that is the reason while covering the financials. Also, in the net margins, AEM doesn't seem to have the best net margins. Usually net margins represent like a company that would have better pricing power. So like Tetradyne, right, they are able to generate better margins. That means that they are able to charge higher for their products. It could mean that they are able to charge higher for their products because they have better products, or whatever the other reasons might be. Taking an example, like Apple is obviously able to charge higher for its products than maybe Samsung, right? That's because they have the pricing power. So Yeah, that could be the reason. But in this specific case, I think it's just because of economies of scale. Like AEM is just such a small company. They don't see that much effects of economies of scale, whereas Teradyne being such a huge company, like it's 22x or more than that. So they are able to enjoy the economies of scale, and hence their net margins are better. But as AEM grows, its net margins will be improving as well. Overall, AEM is the smallest company, but it's also the cheapest one in terms of valuation at the moment. But this is not a surprise. Like AEM is listed in Singapore, right? And the amount of people who have access to SGX is quite limited. So as compared to any company like of the same size and same potential, if it's listed in US, definitely it would be valued a bit higher just because there's more capital over there. But so I believe going forward also, AEM would be valued cheaper than the other companies, but that is just the norm out there. It's just my opinion. I'm not sure how true that is, but I believe that's the case. Anyways, it is more important to us to know that if AEM is a good buy right now, and is it something that will make us money if we buy it. So yeah, comparing it just with the competitors, it seems attractive, but we need to understand the financial and figure out the valuation to understand if we should invest our money in it or not. So moving on to the financials, right? As of today, AEM has reported their earnings until Q1 2021, but let's just look at until 2020 first before we discuss the latest quarter. So the revenue has seen some serious growth in the past 5 years. It grew at a CAGR of 49.2%. In 2020 itself, it grew by 60.8%, and the gross profit margins have improved as well from 33% to 39%. Same story with the net margins, which has improved from 14.5% to 18.8%. Looking at the balance sheet, the business equity has increased by a CAGR of 47.7% in the past 5 years, which is amazing again. They also have very little debt. The debt to equity is merely at 5.34%, which is extremely low. It is good in a way that a company that doesn't have debt cannot easily go bankrupt, right? It's very hard for them to go bankrupt. But it is not also the best way to run a company. I'm no one to say that, but this is what is taught in the capital structure of a company, like how to structure the capital. Because taking on debt to invest in a company, AEM is still growing, so they need to invest capital into the company. So it is thought that the best way is to raise debt, because that way the interest that you pay on the debt is actually tax deductible. So yeah, that's one thing, and it's better than issuing more shares to do so. So I guess AEM should raise some debt. It will increase the value of the company, but it's up to them. I think, I don't know why they're not doing so, but maybe it's just the Asian way of running a company, right? But whatever the case might be, I mean, it's up to them. They know better than me. But moving on to the cash flow from operations, it went positive in 2017, and the 4-year CAGR has been at 14.6%. Not as great as the net profits, but it's fine. I mean, it's growing at the company is growing itself, so their inventory is increasing and all the stuff. It is okay to see a discrepancy in increase in earnings than compared to increase in operating cash flow. Over time, when the company is matured, it will go back to similar numbers. Now they went cash flow positive also in 2017, and it has remained positive ever since. There isn't any drastic growth, but it is fine. The money is being reinvested into the company. So yeah. So financially, the company has done very well up until 2020. But the real question is, are they going to keep up the performance going forward? Because that is what we are buying into, right? The future performance of the company. We have already talked about the ESS business segment representing 96% of AEM's revenue. But one thing to take note is 85 to 90% of that revenue came from one key customer. And that key customer is Intel. So a lot of AEM's performance is tied with Intel, and we all know Intel is not doing so well. AEM had benefited a lot last year from Intel. That's because Intel was investing a lot after they messed up with their 7 nanometer chip. So yeah, they have been spending a lot to get back on track. which was beneficial for AEM because they bought a lot of AEM's equipment. However, Intel really needs to be competitive with its competitors, right? If not, if they're gonna stay at what they are doing right now, then it's gonna slowly be phased out by its competitors. That's what you see. Mainly, they work in two different areas, right? The PC industry and the data centers, right? So for the PC industry, Apple has already switched from Intel to their own silicon. Then you have the other companies, the other laptop manufacturers or computer manufacturers that have, AMD has catch up and actually in some terms better than Intel right now. So they are facing huge competition there as well. So yeah, in terms of data center, data centers are moving to ARM-based chips right now, which Intel doesn't have an offering in. So Nvidia and AMD are already pushing in that sector. So there was a decline in the market share of Intel in both industries, which is not a good sign, right? And AEM driving most of its revenue from this key customer is not a good thing. However, the chairman of the company said if they are able to provide Intel with the equipment, and Intel is able to trust them with the equipment, that means they have some value, right? And it would be easy to convince other customers to buy in as well. So that's what the chairman says, but are they able to pull it through? That is the real question, and it stays as the biggest risk of investing into AEM right now. So when the Q1 2021 results came out, right, everyone was eyeing for the same thing. Has the risk evolved to affect the performance of the company or the growth of the company? And the answer was yes. The revenue for AEM dropped by 45% year over year for the same quarter. That is nearly half, and also the net profit saw an even bigger drop of 63%. And this is the big reason why there was a huge sell-off after the Q1 results. Now going forward, AEM is expecting the demand to be lower in the first half of 2021, but expecting a recovery in the second half when their next generation tools are getting phased in their customers' factories all over the world. Overall, they have provided a guidance of 460 to 520 million in revenue for 2021. They did 520 million last year. So in the best case scenario, they are projecting that they will have zero growth, in other words, which is why you saw like the PEG ratio for next 12 months when we're comparing the competitors. The PEG ratio was higher for AEM because it's not projecting good growths for next 12 months, right? So yeah, going forward, we need to keep an eye on AEM's ability to acquire new customers and big customers so that they can move away from their dependency on one key customer, which is Intel, and the company that is not doing so well as well. At the same time, they also need to grow their other business segments. 1-2% of revenue from a business segment doesn't make a sense. Like you might as well combine all the business segments, right? You need to show some real growth in those. I mean, the growth is good, but then you need to really advance in these sectors as soon as possible to take advantage of the trends that are coming up, like 5G, autonomous driving, and all those things. So yeah, with all this risk in mind, now let's look into my investment thesis into AEM, which will cover all the good things that are working for AEM going into the future, so that you can compare by yourself and make your own assessment if the upside is worth all the risks that you're taking by investing into AEM. So the first thing that is working for AEM is there's a huge push from advanced technology, and the second thing is the geopolitical conditions that are developing around the world. Advanced technology like AI, cloud computing, as well as 5G and autonomous driving are going to be the driving force of advancement in the future. And we are seeing a lot of investments being made into these technology. These technology require high density chips working in critical environments. Hence, testing has become ever more important. In my understanding, SLT, system level testing, is the most efficient and cost effective way for testing these high density chips. Now, I can't say that AEM has a competitive advantage or have better offerings in this space. However, we have seen that they have focused their acquisitions in acquiring the core technology around system level testing, intelligent testing. So we see them working into this space. At the same time, they have established themselves worldwide, like I mentioned, and they have also become part of multiple key committees, such as the testing committee of SEMI Taiwan, the SEMI C testing, yield analysis technical committee, SEMI cast, and the SEMI test vision in California, US. So yeah, they are establishing themselves out there, and they are building up their credibility in the space, which will help them to acquire more customers. Moving on to the second thesis, the geopolitical conditions developing around the world. Let's first look at the semiconductor players. Even though companies like Apple, AMD, Nvidia, and Qualcomm, they design the chips that go into various devices, right? But these are not the companies that manufacture them. The manufacturing is done by foundries or fabs like TSMC from Taiwan or Samsung from South Korea. Now, TMC is definitely the market leader, and they generate 3 times more revenue than the next competitor, Samsung, at the second place. With chips being used in almost everything we use, from a simple toaster to our mobile phone, our cars, and even fighter jets, it is obvious that this is of key interest not just to the companies that rely on them for manufacturing of their product, but also to the governments and companies. The fears were realized when recently companies lost billions of dollars in potential revenue when TSMC had a chip shortage. This has triggered a need for all the major economies around the world to go self-sufficient in terms of chip manufacturing, and they are planning to pour billions of dollars into the industry in the near future. This includes US providing 50 billion in subsidies for chip manufacturing. European Union plans to spend over $166 billion in the next 2 to 3 years. China is set to spend $1.6 trillion in tech in the next 5 years. I'm not sure how much is dedicated towards semiconductor manufacturing, but it is surely going to be a sizable position. This is due to the conflict in between US and China, where US is now stopping technology transfer into China, or even US companies working with China. And US companies actually develop a lot of technology required for the manufacturing of semiconductors. So now, since China don't have access to that, they have to pour their own money and time to develop these technology. All this is also accelerated by the fact that China considers Taiwan as part of its own territory and is willing to take over Taiwan by force if required. Hence, this has triggered more fear amongst other countries around the world, because TSMC isn't from Taiwan, right? So if China takes over, then it controls TSMC's, which is the biggest player in the market at the moment for manufacturing semiconductor chips. So if China controls that, then everybody around the world is at the whim of China, right? Which they don't want, and that's why they all are pushing towards self-sustainability in chip manufacturing. So if you consider this, right, there's a huge money being poured into the industry. That means there will be more factories, manufacturing plants being established all over the world to manufacture chips. Like TSMC has already announced 6 factories being set up in US to manufacture chips, and that means there will be more purchases of testing equipment, right? More demand of testing equipment. This will generate a huge tailwind for the testing industry. However, AEM is specifically in a good position because they don't have any political restriction. Singapore is quite neutral in between US and China, so they can serve both the market, whereas its competitor, the US-based competitors like Teradyne and Kohu, they basically can't serve the Chinese customers. So now you have reduced competition for AEM to expand in China, as well as they can serve US market as much as they want, and also the European market. So yeah, in other words, AEM faces reduced competition going forward. With everything covered, now it's time that we do the valuation. For AEM, it's fairly reasonable to use discounted free cash flow model to estimate the fair value. My model definitely has some assumptions being made, which I will go through, but at the same time, I will also leave the link to the model in the description below, so you can just go access it and make the adjustments to the assumptions to whatever you find reasonable. So for the revenue, right, for 2021 revenue, I'm just taking the average of the guidance that the company provided. So 460 to 520, the average is 490. Going forward for the 2022, I'm taking the analyst projections, which comes out to be a growth of 24.23%. And for 2023, I'm taking a 20% growth, and then onwards 15% growth, which is quite reasonable, I would say. Like if you see whatever different countries are projecting in pumping the amount of money they are pumping into this industry in the next 5 years. All right, for the net margins, I'm taking 16% because like the 18% last year, right? I assume that it was good because of all the benefits that the governments were giving, which I mean, due to pandemic, right? All the stimulus that were pumped into the companies, which improved artificially improved the net margins. But I'm just taking like what was the previous year's one, 2019, the pre-pandemic level, which is 16%. Let's just take that. All right. For all the numbers over here that is used to calculate the WACC, weighted average cost of capital, I'm using mostly the numbers for trailing 12 month. And yeah, the risk-free rate of is the 10-year bond yield of Singapore. The beta is from Yahoo Finance, and yeah, whatever. The free cash flow rate, as you can see, is quite fluctuating. So I'm using the free cash flow rate as 60%. So that means that for our projected time, 60% of the net profits become free cash flow. And the perpetual growth rate is at 2.5%, which is quite reasonable. And yeah, accordingly, the fair value comes to be $2.16, which is actually quite low than the current price of $3.66. So that means that the stock is really overvalued. But if you see, the WACC is actually quite high. 15% is really, really high. And I believe that is attributed due to the fact that the beta is so high. And the reason for the beta to be high is because in the past year, it has rallied. It went from, I think, $1+ to $3 $4. So there was a huge gain upside in the past 1 year. And I think that is just an outlier, and it is not reasonable to take 1.62 as the beta. So if we just take the market rate, right? Let's just take the beta is 1, all right? Then the fair value comes to $3.84, and then the margin of safety you have is 4.59%. It is still not enough margin of safety to go and invest in, even though it's currently lower than the fair value. I would say you should, if you want to buy, the correct time to buy would be in between 330 to 340, I guess. In fact, one of the insider invested, I think he bought 100k shares for $3.32 when there was a recent dip after the Q1 results. So yeah, that's not a huge investment by an insider, but it's still something, and I feel that is a comfortable range, like 330 to 340, if you want to get into AEM to invest in. In the end, I would like to say that AEM is not the best company out there to invest in. Like the risk of the key customer thing, it is really a significant risk, so you should consider it before making any investment decision. Also, me personally, I'm only investing my CPF money into AEM because, well, CPF money is only restricted to SGX, right? Hence, and there is not many companies that I feel I want to invest in SGX. Like, what else I can invest in DBS, UOB, right? The banks. I don't want to invest in STI. So this really makes sense. It gives me exposure into the semiconductor, 5G, autonomous play. At the same time, it's like the growth side where my CPF can get a bit of exposure to. They also pay dividend, so that is good. It's not great, like I think it's about 2 to 3%, but still a dividend. And I think if they manage to pull it off, then they could really be something good. They can provide great returns. All right, so that's about it. That were my views of AEM. In the end, do your own due diligence before making any investment decision. And until the next episode, ciao.